For those of you who don't know, I am Joanne Barry, Executive Director of the New York State Society of CPAs, and I'd like to welcome all of you to our breakfast briefing on non-CPA ownership in New York. Those of you who are physically here in the room, as well as all of you who are joining us via the web this morning for a discussion on this important topic. The Society launched the breakfast briefing series in October of 2008 in order to provide a forum for our members and for other interested groups, other targeted audiences, to really debate the accounting issues of the day. Our breakfast briefings are often controversial, which we encourage. We pick topics that will foster debate, and our objective here is to promote dialogue and to really bring together divergent opinions for the sake of education on the issues for all of us in this room and beyond. Our briefings over the years, and I know many of you in this audience have attended some of them in the past, they've explored tax issues, audit issues, policy issues, and politics. For example, one of the most successful ones that we had explored the tax platforms of the United States presidential candidates just about 4 years ago, when we had a representative from John McCain's campaign here. He was the New York State campaign chairman, Ed Cox. Most of you probably know that name, if not in his capacity in that role, but as son-in-law of our past president, Richard Nixon. And he debated a representative from the Obama campaign. It was a fantastic breakfast briefing and really got this series up and running for us, which was something that we were very dedicated about doing. Another very successful briefing that we had on a totally different topic was a briefing on the Dodd-Frank whistleblower rules. And as a featured panelist for that breakfast briefing, we had Enron whistleblower and CPA Sharon Watkins as a part of that panel. Another fantastic event. We've been recognized with this series for being upfront and forthright in presenting the issues, often uncomfortable to some parties involved, but we feel that it's a role that as the professional society for CPAs in New York State we need to play. Now, what's unique about our breakfast briefings is that we feature a top business journalist as the moderator for these events. In the past, for those of you who have attended before, we've had reporters from the Wall Street Journal, from Times, the New York Times, from The Economist, just to name a few. For this briefing, we talked a lot about who should moderate it, and we decided that it was important that our moderator be familiar not only with this particular issue, but with the profession itself. Bill Carlino, who is sitting at the far end of the panel here, is a veteran journalist. All of you, I'm sure, know his byline. He's editor-in-chief of Accounting Today, as well as editorial director for all accounting-related content at its parent company, Source Media, including the online portal we're all familiar with, accountingtoday.com. All of us check that every day, I'm sure. He has been a frequent speaker and panel moderator, as well as a featured commentator on a dozen, probably, cable outlets, including Bloomberg, CNBC, CNN, MSNBC, National Public Radio, and Reuters. Bill and I have worked together in different circles of this profession. We were just talking about it for a little over 11 years. I have tremendous respect for his knowledge of the accounting profession, and I think he is the perfect person to moderate this panel this morning. So please join me in welcoming Bill Carlino as our moderator today.
Well, thank you for that kind introduction, Joanne. And I will reiterate Joanne's remarks. I think we do have a great topic this morning. It's going to inspire, I think, a lot of passionate discussion. I'll say from the outset, I'd like to make this interactive. If you have a question, you please feel free to ask at any time. And if you have a question directed at a specific panelist, please indicate that. The format we're going to take today is I'll give a brief introduction of our panelists. They'll each give a 5 to 7 minute opening statement on their position regarding CPA ownership, and then we'll get right into the questions. Let's start to my immediate right. Somebody I'm sure a lot of you already know is Charles Weinstein. Charles is the Chief Executive Officer and member of the Executive Committee of EisnerAmper, and prior to the formation of EisnerAmper, he was the managing partner at Eisner. He has more than 25 years of audit, merger and acquisition, and public-private financing and industry consolidation experience, with a particular focus on SEC reporting and compliance issues. Charles has served companies in a variety of industries, including technology, pharmaceuticals, health sciences, manufacturing, distribution, and travel. And Charles was also telling us before the presentation that he is going to Sunday's game, the Super Bowl. Please welcome Charles Weinstein.
Thank you. Let me just take a brief moment to introduce my firm so you have a little background on EisnerAmper for those of you who don't know the firm. So we are a multi-state and I would say multinational firm. We have offices in New York, New Jersey, and Pennsylvania. We also have an office in the Cayman Islands. And our view of the world is that most of our growth will come from being in other states and expanding our geography, both nationally and internationally. We have about 1,200 staff, 170 partners and principals, and over $250 million of revenues. The core practice areas, and of course we have a very diverse client base, but the core practice areas for the firm: financial services industry, which to us means primarily hedge funds, private equity funds, broker-dealers, venture capital firms. We do some banks, and we do a significant amount of work in the insurance industry. We work with public companies, auditing perhaps 60 to 70 public companies and serving an additional 100 public companies as well. Technology firms, all aspects of technology, and high net worth individuals and families. Those are our core practice areas and where we see our greatest opportunities for growth. And that sort of colors my view on this subject matter, which is ownership for non-CPAs in CPA firms. And in our experience, we perform audits for many highly complex businesses. And in order to run our audit practice, we have professionals with many different skill sets: valuation, technology, international taxation, etc. And they're not all CPAs. One of the things that we talk about in the firm all the time is sort of the ethical compass that we try to have inside the firm. And we like to say we don't make business decisions. When we work with clients, we don't make business decisions. We make decisions based on the accounting facts. And whether we're CPAs in practice or anyone who rises to a level of decision-making inside the firm understands that implicitly. When we go out into the marketplace to work with clients or to perhaps propose on a new client opportunity, we go in with a multidisciplinary team. And we need individuals, in order to serve the markets that we compete in, we need individuals with great and diverse skill sets. It would be hard for me to imagine in this fair value, quote-unquote, fair value world that we live in public accounting, it would be hard for me to imagine performing audits without very sophisticated valuation people inside our firm. We couldn't work with multinational companies if we didn't have international tax experts inside our firm to help us get through tax provisions. Many of those professionals are not CPAs. Many of those professionals are lawyers. Certainly with the technology companies that we work with, we have a need for people who understand technology, the application of technology. We read contracts as they relate to audits and financial statements on a regular basis. So we don't believe that we would be able to provide effective audits, which we think serves the public interest, without attracting and retaining people from diverse backgrounds. And we understand that while they're not CPAs, they are with the firm and they do follow the ethical compass that we have inside the firm. And the best way to attract and retain those types of individuals is for them to have skin in the game, for them to have ownership and equity in the firm, for them to participate in the profits. We can pay a salary, but we can't necessarily compete with other professions, or we can't necessarily compete with other businesses just by paying a salary. And by offering ownership opportunities to those individuals, we think we can do more effective auditing. Ownership aligns the interests of all the key employees in a firm. As I said, they have skin in the game, they have capital at risk, they share the risk that the CPAs in the firm have. It's interesting to note that New York already has a rule that provides for up to 35% of the profits which can be shared with non-CPAs. You can't have ownership, but they can share in profits. My understanding is that recently the engineering profession provided for non-licensed ownership for engineering firms. And just to go back a little bit, one of the pet peeves that I've always had, which I'm a little passionate about, was that CPA firms and CPAs in New York should be able to compete on a level playing field with CPAs around the country. And overwhelmingly around the country, other states already provide for non-CPA ownership with certain safeguards. So to level that playing field, I think it's important for New York State to recognize that in order for us to be able to practice most effectively, we have to be able to compete. And my other pet peeve is with the alternative practice structure. So apparently it was acceptable under the alternative practice structure regime for that to be acceptable for New York State. And you had firms in an alternative practice structure where you had just a group of partners operating in quote-unquote a CPA-owned firm. They had no capital in that firm. They had no employees in that firm. They borrowed everything from another related entity, which in many cases was a public company. So to the extent that the CPAs had no capital, had no financial risk whatsoever in a CPA firm, it seems to me that if you cut through and you really look at substance over form, we've had non-CPA ownership far beyond the bounds that I think is appropriate, but we've had non-CPA ownership in CPA firms for a long time already.
Okay, thanks, Charlie. Of the 48 jurisdictions that allow CPA firm ownership, South Carolina is the only state that requires a supermajority of 66 2/3% instead of a simple majority of 51%. And we're very fortunate today to have someone from South Carolina. Chuck Talbert is a shareholder, director, and member of the executive committee of McAbee, Talbert, Halliday Company, a firm based in Spartanburg, South Carolina. Chuck is a current member and past chairman of the National Uniform CPA Examination Review Board and is a past chairman of the South Carolina Board of Accountancy. Please welcome Chuck Talbert. Chuck?
Thank you, Bill. I appreciate you having me here. Bill indicated that South Carolina has a supermajority, and I think we're actually the only state that has a supermajority with regard to non-CPA owners. Frankly, and I'll just cut to the chase with regard to that, it was by happenstance. At the time, and we implemented or passed into law non-CPA ownership back in '98. At the time, I was president of the society in South Carolina. Non-CPA ownership was one of several issues, including commissions and contingency fees for CPA firms. So several issues were flowing through. As we were developing our legislation, the UAA at the time actually had a supermajority, and that's what we were modeling after in terms of drafting our legislation. By the time our legislation got around to vote time at the legislature and we had the votes, actually it had changed to a simple majority. And we didn't see any method to go in and change that, and I don't know that there was any appetite to do that. And frankly, since that point in time, as we have opened up our Practice Act, the question has frequently come up about the non-CPA ownership supermajority. It seems everyone else has a simple majority. But again, there's been no appetite to really address that issue. There have been other issues that have driven the charge with regard to opening up our Practice Act. So why supermajority? Happenstance. And I think had the simple majority been in place with the UAA, for example, when we started our initiative, we probably would have that today. You know, from thinking about this from a New York standpoint and kind of the ideas that we went through, and this was 98, mind you, we looked at the circumstance from the standpoint of, and I think Charlie's kind of alluded to it, that there's a reality of the existence, whether you want to call it form over substance, anyway. And we felt like we were dealing with that. Since that time, in, I guess, 05, 06, I was chair of the Board of Accountancy, so I had a regulator's hat on. And, you know, my position really has not changed since. You know, I looked at it at that point and continue to look at it today, and I would suggest that if you, as you pursue this question in this state, you don't necessarily look at it from, you need to consider, you know, why are other CPA firms allowed to do this when we're not? So they have a competitive advantage. I would suggest that you take the position of what's good for the public. Does it harm the public in terms of having non-CPA ownership? And I think you need to answer that question as you go forward, not just how it positions New York CPAs versus other CPAs. I'll leave it with that for now.
Okay, thanks, Chuck. Our next panel member comes to us from across the river, New Jersey. Alan Sobel is the managing member of Sobel & Company and is responsible for facilitating the strategic direction and day-to-day management of the firm. In addition to his firm's responsibilities, Alan provides expertise for clients in the areas financial reporting, tax planning for businesses and high net worth individuals, as well as strategic business planning for corporate clients. He also has considerable experience with M&A and acquisitions and delivers value-added working service with clients on sourcing deals, negotiating, and structuring transactions. Please welcome Alan Sobel.
Good morning, everybody. On my drive in this morning, I couldn't help but pass by MetLife Stadium, so in an homage to the New York Giants, let's go Giants this Sunday. For you Patriot fans, I'm sorry. My issues, or my story, is a little bit more practical than perhaps some of the other panelists here, although Charlie, I know, has a big New Jersey presence as well. We are a New Jersey firm that is registered to do business here in New York. We do a fair amount of attest work for New York clients, and therefore we're required to be registered. And New Jersey allows for non-CPA ownership at a 51% majority for CPA level. And so when we formed our organization and we had admitted some non-CPA partners to our firm, when we registered with New Jersey, we had the practical realities of having to unwind what we did. So you can only imagine what it was like to talk to my then partners and who were non-CPAs and say to them, by the way, you are now no longer a partner of the firm, but rather you are going to be a principal. You can still share in the profits, as Charlie alluded to. They can share in up to 35% of the profits under New York regulation, but you will no longer have a vote or say within the organization. Needless to say, it didn't go over particularly well, but the fact of the matter remains is that our partners are committed to high ethical standards and maintaining, you know, the standards and the regulations that we're bound by as CPAs, and swallowed hard and took the news about as well as they could be expected. But once we got over that hurdle, you know, we effectively are operating as a CPA firm with non-CPA, not ownership, but non-CPAs who have a very important stake within our organization. And so as a practical matter, from a form matter, we are certainly complying with all of New York rules and regulations. From a substantive matter, at the end of the day, we are essentially accomplishing what we've always wanted to accomplish with our non-CPA members, yet we're having to jump through hoops to get there. And so for us, it's really an issue about who should have a seat at the table, what contributions are people making, what are they doing that earn their right to be a so-called principal or a partner within our firm. And for us, it just boils down to the fact that there are different disciplines that people bring in today's environment, whether it's tax attorneys who are not CPAs, yet demonstrate the competencies and the capabilities and the leadership abilities that we would expect of a partner. Or in our forensic area, we have people that, a guy who heads up our group who is an accountant but non-CPA, who came from law enforcement, just never pursued a CPA, yet probably knows more about fraud and white-collar crime than any CPA that I would ever meet, and that's an important part of our practice. Or whether it's strategically not in a service area, but the way that we are growing our firm and maintaining our competitiveness so that we can continue to thrive as an organization in marketing. We have a marketing principal who is, has a tremendous reputation in the field and demonstrates those competencies as well, and adds strategically to our firm at a very, very high level. To treat them, these individuals, as second-class citizens is a little disconcerting. They are, at least in the collegial sense, they're our partners, and they add just as much value as everybody else. And so while I do understand the need to protect the public's interest, I recognize that it is firms that can be regulated through the peer review process and through other ways to ensure that there's a high level of standards that are maintained. And so long as the CPAs are managing and, I should say, controlling the firm, we should not find ourselves with us diverting into choices that are not within the public interest. And if we were just an audit firm, I could understand having only CPA ownership, but firms are no longer just audit firms any longer. We are far more complex and much more viable to that. And again, for us in New Jersey, as we cross the border, we're having to deal with the New York issue on a real level of having different rules in different states. And I think New York, as a member of the New York Society of CPAs, as a licensed CPA in New York, although not a resident, I do encourage New York to move towards a non-CPA ownership model that's consistent with the Uniform Accountancy Act model.
Okay, thanks, Alan. And last but not least, to my far right, Robert Goldfarb is managing partner of Schoenfeld Mendelson Goldfarb out on Long Island. He's a certified financial planner, certified fraud examiner, and a tax partner in the firm. He is often called upon to examine the books when there are questions of fraud, and he's considered an expert helping small businesses succeed, and was Business Person of the Year recently for his service while president of the Great Neck Chamber of Commerce. He also serves as president of the National Conference of CPA Practitioners. Please welcome Bob Goldfarb.
Thank you, Bill. Bill did neglect to mention I also am a CPA, and I just want to make that clear. It's interesting that there's a space between us here. I'm not sure if that's intentional or not, but clearly I'm on the other side of the picture here, and I don't believe that there is a need in New York or frankly any other state, but I don't deal with any other state for non-CPAs owning a CPA practice. My firm is considered a small firm, I guess. I have 3 other partners. We have 10 staff, most of which are CPAs. We do litigation support. We do forensic accounting. We do some of these other non-CPA, non-auditing issues, but we don't see the need to have non-CPAs as owners. We function properly within ourselves, and we are able to function without non-CPAs as owners. My concern has always been that we started this profession on an auditing plane. That is our primary goal, that remains our primary goal, and to bring non-CPAs into a CPA auditing practice is just against public interest. I do wear that regulator hat as well right now. I am a member of the New York State Board of Accountancy, and my primary objective in any decision that I make there is what is in the best interest of the public. And it's not a matter of does it do no harm, as some of these panelists have said. I don't think it's a matter of does it not do harm, but is it in the best interest of the public? And I'm not so sure that bringing non-CPAs into a CPA firm as owners really is in the best interest of the public. Alan indicated that he had to unravel what he did. I don't know, I didn't ask Alan, but I would venture to guess that although the partners that were partners that got tossed out as partners and now principals, they probably didn't leave the firm either. And I'm sure they have an influence in what they're in the management. Maybe they don't have a vote, but I'm sure they have an influence. My concern is with the smaller CPA practice, say there are two people, and one has 49%, one has 51%. The fact that there is an ownership, a minority ownership, doesn't make non-control to the non-CPA or to the CPA owner. The 49% owner still has significant influence, and perhaps the non-CPA at 49% may have 70% of the revenue that's generated. That would have a significant influence on the decisions. And I'm not saying that a smaller CPA firm has different ethics. I think our ethics are the same as Charlie or Chuck's or Alan's. We agree that ethics is primary. We don't make decisions based on business decisions for our clients either. But auditing is primary. We take that quite seriously. And I think that a CPA firm, known as a CPA firm in the state of New York, should in fact be owned only by CPAs.
Okay, and that was not intentional, by the way, that space, John. Bob, I was just like, all right, as I mentioned, please feel free to ask any question. If you have a question directed at specific panelists, please indicate that. I'd like to start off with this. If you go back about 10 years, there was some discussion, heavy discussion in the profession about how the CPA brand was not being, not recognized, but not being promoted as such. And they've kind of they rectified that over the next few years. But now with this preparer registration, now there's a tax preparer, and how do you differentiate that from a CPA? My question to the panel, the first one would, since many of you are for the non-CPA ownership, does that in any way, do you feel, does that dilute the brand of being a CPA? After all, you folks have gone through one of the most rigorous tests in professional services. Would non-CPA ownership of a firm in any way dilute that? Charlie, I'll start with you.
I would take the view that it does not dilute the brand. There are, I believe, appropriate safeguards in place. The CPA designation, the license that we have, the single license that we have that other businesses can't do is the ability to sign attest engagements. And other than that, every other service that we provide comes with competition from non-CPA firms. If you look at what's happening in the marketplace, having the CPA firm designation, I believe, actually enhances your ability to compete in those other areas of practice, whether it be tax, whether it be forensic accounting, litigation support, because the value of the CPA brand implies that the ethics and the qualifications of CPAs stand behind the services that are going to be rendered in these other areas. And to the extent that a CPA firm is made up of practitioners who have varying capabilities and diverse set of skills, but they're still governed by the ethical requirements of practicing as a CPA firm, I think that enhances your value. And non-CPAs as owners, that fact doesn't change the requirement to adhere to the standards of the profession. And I do believe it draws other types of skill sets under the CPA umbrella. So I don't believe that it would dilute the CPA brand.
Alan, let me ask you something. What criteria, toward Charlie's point, what criteria do you implement to ensure the appropriate competency of non-CPAs?
So what we look at is a similar process that we would do for CPAs, with the exception, obviously, of the CPA designation. First and foremost is technical excellence. Do they demonstrate the excellence in their area, whether it's tax, whether it's forensic accounting, whether it is in the area of marketing, or perhaps down the road it could be in human resources? Do they demonstrate the technical excellence that we would expect of anybody in a partner role who's a CPA? Yes, they don't take an exam, but you know, I took the exam 20 some odd years ago, and you know, I demonstrate my excellence every year, year in and year out, not because I took that exam when I did, but rather because I continue to train, I continue to take continuing education, I continue to read, and I continue to raise the bar of my competencies. And so anybody who's going to be there first and foremost would be technical excellency. The second criteria that we look at is leadership. Leadership within the firm, leadership within the profession or within their own area of expertise, as well as leadership within the community. And so the standards that we have for entry of a non-CPA partner, with one exception, having passed the CPA exam and having that designation and license, is identical for a non-CPA partner as it is for a CPA partner. So we measure that, we look at that, and if they demonstrate those capabilities, they would be considered for partnership. And then they're required to maintain that same competencies throughout their career, or like any other partner, CPA or non, they would be, you know, fired from the firm. So whether that's through continuing education, they maintain the same requirements as we have. Just because you're non-CPA, you're still required to maintain 40 hours at a minimum of continuing ed. So there are all those things come into play, and so our standards are really no different with the exception of that exam.
Chuck, a lot of us are not familiar with the with South Carolina as far as the practice.
Oh, I'm sorry.
Go ahead.
I was going to just try to respond to
Absolutely.
if I can. It's interesting that Alan notes that he maintains these standards within his firm, but that's not within the legislation. The legislation doesn't say that you must maintain this, and I'm concerned that without adequate legislation allowing non-CPAs in as owners, that there is no 40 hours of continuing ed requirement. And what continuing ed requirement would there be for a travel agent being an owner of my firm? Okay, that's a little bit of a stretch, but it doesn't say that a travel agent can't be a member. It doesn't say that it has to be an engineer or some other professional. It says that it just that non-CPAs could be owners. So what continuing education does an engineer or an IT person being an owner of my firm have to have? I think the fact that we do have the CPE requirement and the new competency requirement in New York State is sufficient to make sure that the public interest is maintained. And regarding the brand being diminished, I do believe that the brand gets diminished by bringing non-CPA owners into the CPA firm. Charlie had, interestingly, he sort of turned it around a little bit in my mind. He said that the CPA brand is enhanced by bringing them it enhances what he's doing. We need that enhancement, and he says that, if I recall the words exactly, that it brings a bigger elevation. It elevates his firm because of the CPA brand, even though there are non-CPAs as principals and managers in there. So why would we want to diminish the value of the CPA certificate? I worked hard, and I feel we need it.
If I could just respond, again, to my knowledge, and I can't tell you that I know every nuance of the rules, but if we are members, if we're a CPA firm and we're members of the American Institute of CPAs, I think it is required that all professionals of the organization, whether you're a CPA or not, are mandated to have 40 hours of continuing ed. So while New York's legislation perhaps doesn't have it, I think New York's requirements does require peer review, and within the peer review standards, at least of the AICPA, all professionals are required to have 40 hours of continuing ed.
Charlie, I'm sure, could respond to that a lot better than I can, and so can a few other people here that do peer review. But I was on council for several years of the AICPA, and my understanding is that you do not need, that non-CPAs do not need 40 hours of CPE in order to maintain the CPA firm. I do as a CPA, but my non-CPA partner would not have to do that. And what CPA? They have to take auditing? What would be the requirement? An engineer take auditing credits? I don't think so.
We had a question.
Ross Cass, Javelin's Cass and Company. Ross Cass, Javelin's Cass and Company. We have history on this issue already. If you take something that happened before, when non-CPAs represent too much pressure on management or too much revenue, they control the firm. So when a firm does 10% auditing and 20% or 70% consulting and other work, then clearly it's not an auditing firm anymore. Now, we have the PCOAB and all those restrictions set forth by them because the accounting profession in the past has failed. We let the greed of the other types of revenue sources take over from the auditing. And from the public's perspective, we should be auditors. We should be independent. We should not be trying to sell our clients services other than that which is traditionally a CPA firm. There are consulting firms that can do that, and that's why they should be principals. I mean, partners in those kind of firms. Yes, we allow for principals. We allow for revenue sharing. We can have highly compensated professionals within our firms already, but we should keep our integrity and stay CPAs.
I believe the lady in the front row had a question.
Yes, Barbara Josephowitz speaking. And Mr. Goldfarb, in connection with your remarks, the various professions that are likely to become part of a CPA firm under the proposed legislation would probably be the legal profession, possibly the actuarial profession. These have their own standards of conduct, their own professional codes. Is it possible that we could have a conflict between the accounting standards of professional conduct as well as the codes under these other professions? For example, there is in the legal profession the requirement that there is no such thing as the unauthorized practice of law. Do you think this could pose an individual conflict within a particular firm that is going to allow ownership by an attorney? Thank you.
Okay. First, I just want to set the record straight that there is no legislation pending. I don't know of any legislation that is going to be pending in the near future, so it's conceptual right now. But I totally agree with you that one, how does the State Board of Accountancy, which licenses CPA firms in New York, regulate a non-CPA owner of a CPA firm? Yes, you can regulate you can discipline the firm, you can discipline the CPA partners, but how does the State Board of Accountancy discipline the non-CPA? And I do believe there could be a conflict of interest between, or conflict of ability for the State Board of Accountancy to discipline an attorney that has no jurisdiction over that. And the requirements for an attorney are very different than the requirements to be a CPA, and there may very well be different, not ethical standards, but certainly different CLE requirements, different maintenance of your license. And I'm sure that if I wanted to be an owner of a legal firm, a law firm, they wouldn't allow me to do that just because I have a CPA certificate. And where is that line drawn? So I agree with you.
Sir?
Jeff Resnick, Managing Partner of the Resnick Truckman Group. I guess just a few comments. And as some of the panelists already said, in essence, we already have non-CPA ownership. So to say that it's not here or it shouldn't be in New York is almost foolish, because, you know, Alan came into New York from New Jersey, and as he said, he had to jump through hoops or change his structure, but nothing really changed. Those same people still sit at the table. Yes, they quote-unquote don't have a vote, but now they can only share it up to 35%. I don't know what they shared before. And they're still the same people, the same thing. Instead of a partner, they're called a principal. As far as history, we do have history. 48 other states allow it. And I don't see a major, not uproar, but we don't see major challenges in any of the other 48 states. We don't see major issues. We don't see major problems. So New York, being one of the only states that does not allow it, it's almost form over substance. It happens here every day. I would say there is a lot of firms that have non-CPA ownership. We've had it elsewhere. We have it in other states. It just seems silly.
Well, to your point, let me, you talked about other states. Let me find out about South Carolina. Chuck, has SC experienced any conflicts as a result of non-CPA ownership?
Well, and that's exactly what I was going to address. Again, our law was passed in '98, and the reality in '98 was we already had it. We had it. It existed, and I guess the position I would take on that is if something is in existence in substance, why would you fail to regulate that? I mean, I do think also to Bob's point of, yes, you can't necessarily regulate the non-CPA because the non-CPA is not a licensee, but you can certainly regulate the registered firm. You can bring, fines and whatnot, and frankly, and I think Charlie and I were having this discussion prior to the session, perhaps you would actually penalize the non-CPA in a more draconian way if they were a partner, because you could reach into their equity and hurt them where it really counts. If there was some item that required board action. And I'll tell you, I did make an inquiry with the executive director of the South Carolina board. To her knowledge, since '98, there has been no disciplinary action that has come before the South Carolina board that originated as a result of a non-CPA owner situation. So there's been a lot of disciplinary action since '98, but none that when you drill down resulted from this issue.
Charles?
Yeah, I'd like to just address a comment that Ross Cass made in terms of we should be an audit firm, and not EisnerAmper, but accounting firms should be audit firms. That should be all that they do, and that if you're an audit firm, you should be licensed as a CPA. Well, first of all, it's well established, and if you look at this panel, Bob in his bio talked about all the forensic accounting he did. He did not talk about any of the audit work that he did. Alan's firm has a significant practice in forensic accounting as well. Chuck, I'm not familiar with your firm, but I know you have an audit background. I personally have an audit background. But CPA firms, as they're constituted today, do not have to be audit-only firms. And to the extent that you sign off on an audit, the responsibility for signing off on an audit, whether your firm does 70% forensic accounting work and 30% auditing, the responsibility, the ultimate responsibility and the personal responsibility for that does and always will rest only with a CPA. So I think you have an adequate safeguard with respect to the fact that a CPA is signing their license. They're putting their license behind anything they sign that relates to an attest report. So I think we do have that safeguard in place. And I don't think we'll ever, this is not a debate about whether we move back to an audit-only model, as you may have suggested in your comments. This is really a debate about how CPA firms operate today and what safeguards are in place and should be in place to protect the public interest.
Before we go to the audience, let me take some questions that are coming in online for our online listening audience. And this may be a question for the folks at New York State. If so many other states already allow non-CPA ownership, has there been any formal research into the pros and cons of allowing the non-CPA partners with respect to those states in order to determine if this is the direction New York State should go? Are any of you aware of any kind of research they've done?
I'm not.
Okay. And the second one is, I think we touched on this a little bit, this is regarding CPE. Would non-CPE partners as individuals be subject to the same CPE and ethical requirements by the state? The Board of Accountancy has in the past stated they cannot conduct enforcement on any non-CPA. I'd like to get your comments on that. Bob?
That's one of my primary concerns, that the reach of the State Board of Accountancy is not to the non-CPA owner. Charlie mentioned that, or Chuck did rather, that there is the ability for the firm, the CPA firm, to discipline the non-CPA. I agree with that, but that's within the CPA firm. That's not within the State Board of Accountancy's purview to do that. And my concern is you can do anything you want within your firm. I can attempt to fire my partners. It's no different whether that it's a CPA or non-CPA. I have the same reach and the same ability to fire them or discipline them or penalize them any way that the partners decide. But does the State Board of Accountancy have the authority over the non-CPA? The answer is no. Yes, they can discipline the firm, and yes, they can discipline the supervising partner, CPA partner, but they cannot discipline the non-CPA. And that concerns me. Where is that reach?
Hi, I'm Mark Meinberg.
Just wait for so our online audience could hear you.
Good morning. I'm Mark Meinberg. I'm the managing partner of what I would call a small firm. I was recently a little under 20. We did a merger. We're under 30. We still think with 6 partners, that's a small firm. So I thought it was refreshing to hear the perspective of larger firms. And I think that usually the profession thinks that large firms and small firms are aligned differently. And I come away this morning, because I've come out in favor of non-CPA ownership, hearing some of the same concerns about the complexity of the work that we do, needing better skilled people that maybe aren't always CPAs to help us do the work. I think I heard leveling the playing field. So those are the types of things that I think excite smaller firms. That being said, I think that, we always have to do what's in the public's best interest. And I don't think that the public is asking that their firms provide only what I call the Model T service. You want a car, it's black, it has 4 wheels and a steering wheel. No, I think that they want the things they've come to be accustomed to from whether we're small firms like Bob and I or larger firms like the EisnerAmpers. They want a full-service firm. And I think that we're dealing with change now. Change is always challenging, but it's also exciting. And I don't think we can ignore the opportunity, particularly because 49 other states have accepted it. And I would like to play on a playing level field. And I think, as you said, you're competing against people who can come into your state, because we dealt with that issue successfully 2 years ago. And I think we have to deal with this. I understand Bob's point on how do we regulate, but I think we have 2 issues. I think we have to first embrace, is this change right for us? And if it is, let's deal with the legislative aspect of it. And I think that we've always, as a profession, come to reasonable terms on how we impose regulation and compliance over those of us that are not, quote, CPAs. I think we could do that as a profession. And then when I hear people say, oh, well, now we're going to bring people into our fold that we can't discipline. And I think of all the horror stories and the bad stories we've read within our profession of firms that didn't build a culture. They failed to provide ethical structure. So that challenge isn't going away, whether it's a CPA or a non-CPA. So I think we have to always address that. And the thing that I didn't hear this morning, but I throw out to the panel to maybe address, is one of the reasons that pushes me over the edge in favor of non-CPA ownership is, as encouraged as I am with the increased enrollment numbers of young people wanting to come into our profession, I still think we have succession planning issues. And why shouldn't, if we do things that are in the public's best interest, why shouldn't our clients demand that if someone they worked with in our firm who is a non-CPA and provided them the service, why should that person be held back from being a partner? Why should we, as smaller owners, limit the ability who can succeed us and follow in our footsteps? So I throw that succession question out.
Okay. For the record, Mark and I are pretty good friends. And so Charlie and I would hope to think. But Mark made some very interesting points, and I understand the point, but the points that he made. But the complexity issue that both Mark and Charlie and actually Chuck and Alan made, the issue of complexity doesn't change because there are non-CPA owners. The complexity is still there. The need for outside or inside professionals who are not CPAs doesn't change. I'm not saying don't have non-CPAs in the firm. If that's what you need and you're big enough to afford it, bring them in. It doesn't change the issue of whether they're owners or not. So I don't see where that is really a benefit to the firm or the public. The change, Mark, I agree, change is exciting. I like the idea of change, but change just for the sake of change doesn't do anybody any good. And because this is a change doesn't make it the right change to make. To bring in non-CPAs just for the sake of, oh, well, now we're going to bring people into our fold that we can discipline them, I think that's bucking tradition or what we have always done in the past. Sometimes the past is the right way to be. New is not always better. So I'm concerned about the concept that we have to change for the sake of change alone. And also the issue of succession planning. It's interesting that you bring that issue up because it leads me to think that you need non-CPAs in your firm to have adequate succession planning. Smaller firms probably do have succession planning problems, but to replace me with a non-CPA so that I can get bought out of my firm sometime in the future, I don't think that's in the best interest of the public either.
Ralph, I think do you have a question? Ralph, your microphone.
Thank you. Ralph Albert Thomas, Executive Director for the New Jersey Society of CPAs, where we do have non-CPA firm ownership. I guess the concern that I have is, once again, looking at today's landscape and the fact that the audits today are not the audits of 20, 30 years ago, and the fact that empirical studies indicate that when you have a very multi-discipline team approach and inputs coming from a number of areas, that the end product comes out. And I think at the end of the day, we're concerned with having an audit that is a good quality product. So to not avail ourselves of having individuals who bring something to the table that would help with this, and doing it in such a fashion that they just aren't, quote, like subcontractors, if you will, and part of the firm, I think is important in today's environment. And I do think that there are ways to address the control point that you said. I know, at least in New Jersey, that our State Board of Accountancy is under the auspices of the Division of Consumer Affairs, and that individuals who, whether they're CPAs or non-CPAs, if they're not doing the right thing out there, they are subject to being regulated by the Division of Consumer Affairs. So I think there are ways to address the concern of not being able to go into the firm and discipline, if you will, or address bad behavior of a non-CPA owner. But I think to not move forward, and I agree with you, don't do change just for the sake of change, but I do think that you have to take a look at, are we where we should be in today's environment, and being able to address the needs, and also in protecting the public interest by having individuals who are non-CPAs contributing to the essence of delivering a quality audit product.
Well, I started my CPA career with Pricewaterhouse, and I would say that's probably a large firm. I'm not sure if it is anymore, but it had been when I was there. It used to be one of the big 8, I guess. Now it's one of the big 4. But we obviously didn't have non-CPA owners at the time. Was quite a while ago. But we always brought in specialists who were able to work in the firm to do the part of the audit that CPAs were not able to do. I'm sure Charlie has on staff those competent individuals to be able to do that work. It shouldn't change the quality of the audit or the complexity of the audit or the ability to do the right work just because there's a partner who has an ownership interest that's a non-CPA. The quality of the audit should be the same. The quality of the work should be the same. The fact that the work is generally done in the field. And I'm sure that a lot of the people that do the work that Charlie needs done, or the other large firms, they're not all CPAs doing that work. I don't have a problem with them doing the work, but I do have a problem with the responsibility lying in the CPA that signs that opinion. And I understand that it would still be a CPA signing the opinion, but the discipline to go back to the non-CPA, maybe there can be provisions in a legislation. I have not seen that in other states at this point, and I'm not versed in every state either, but I do have a concern for the ability to go to the non-CPA and discipline them through the State Board of Accountancy.
I've got a question for Bob. logistics with regard to the Board of Accountancy and how you regulate mobility. Now, I understand Alan's firm is registered both in New Jersey and in New York and had to de-partner, if you will, certain individuals. But what if he were a registered firm just in New Jersey across the state line and had non-CPA owners, came into the state of New York and did something that required a disciplinary matter? Under mobility, would the Board of Accountancy here not deal with the firm, recognizing you cannot deal with the non-CPA owner in New Jersey? I'm just, it seems like the same situation, except you're talking a few miles across a state line. I'm just curious.
Well, the distance between New York and New Jersey is enormous. But at least those of us in New York, we think it's enormous. Not in New Jersey. That was an issue, quite honestly, Chuck, before mobility was approved in New York, and it was just recently approved in New York. But in order for a CPA firm outside of New York to work within the boundaries of New York, they must submit to the disciplinary actions of the Board of Accountancy. So the firm will come under the jurisdiction for the work that they do in New York State.
Which would mean that the individual licensee of New Jersey would come under the jurisdiction of New York. However, if they had non-CPA owners and participated in some situation that required a disciplinary matter, you would not have jurisdiction over that individual non-CPA owner.
We would have jurisdiction over the firm,
over
yes.
the firm,
and that concerns me as well.
Right. And that's where you end up. That's where states end up once they adopt non-CPA ownership. They have jurisdictions over the firms, not the individual licensee. It's not a licensee; it's a non-CPA. So you're in the exact same situation with regard to mobility, it seems to me.
I'm not so sure, because I think the Board of Accountancy would be able to go personally after the licensee as well as the firm. Now, if there's no licensee, again, that's my concern. There's no ability to go after a non-licensee, and that person should not be doing audits, should not be allowed to sign an audit opinion in New York State.
They can't sign an audit
They can't, I understand. Okay, and thank goodness for that.
But
So what is the need? What is the need to have a non-CPA owner if the responsibility is still going to be with the CPA? I don't see the need for the owner.
Because we're not just
I
audit firms
understand
anymore.
that part.
And I might add, by the way.
I was going to say, I think this ignited some passion here. This gentleman's been waiting a while.
In fact, just one thing, real quickly. The failure of Enron was not the failure of non-CPAs, it was the failure of CPAs. The failure of Bernie Madoff was not the failure of non-CPAs, it was the failure of CPAs. So at the end of the day, you have in New York the ability to discipline the CPA when they fail on a test of services, and under the Non-CPA Ownership Act, you will still have that same capability.
You're not implying that the CPAs are less ethical than the non-CPAs?
I'm not implying that at all. I'm saying they are equally vulnerable to being non-ethical.
A bad person is a bad person.
Exactly.
This gentleman's been waiting a while here.
My name is Alan Weiner, and I'm speaking on behalf of myself, not my firm. I was the Y2K president of the State Society. I had one point when I first raised my hand, and since my hand has now been up for about 5 minutes, I probably have about 4 points to make. First of all, I feel sorry for Bob being just
Look
on
at
that
this.
side.
Well, mine hasn't stopped him from talking. Yeah, it's just-
I'm in
At least
favor
somebody
of-
feels bad for me.
I'm in favor of non-CPA ownership, and the points that I will make are, back in the 40s, there were cases as to whether CPAs could prepare income tax returns, which we now all take for granted. And this was a New York State case, because the legal profession regarded it as the unauthorized practice of law. And through case law, it was decided, yes, CPAs or accountants actually, didn't have to be CPAs, could prepare income tax returns. And as I said, we just now accept that because it's some 70 years old. So I don't, I see an analogy between what happened then and what's happening now. The other point that I would make is we have a concept in New York, or an entity called a limited liability partnership. And we are, under our state's law, in order to form a limited liability partnership, it can only be owned by professionals in New York. So you have the legal profession, you have the engineering profession, acupuncturists, and CPAs. So if non-CPA ownership becomes the law in New York, I believe you'd also have to perhaps change the law regarding limited liability partnerships. That's not really a question, that's just a statement. But I believe that that's the way to go. I just think you have to cope with it. As this breakfast briefing goes on, I have a few other comments to make, depending on what I hear from the panel. Just concerns or considerations that need to be taken up if this progresses to a point where legislation is proposed. And actually, one of the comments I'll make later affects South Carolina's law and the other 47 states. Pick on South Carolina only because we're the guest, but that is a problem now based on non-CPA ownership. So I'll just whet your appetite for that comment that's coming later.
Good morning, Donald Ingram. If Mark's firm is a small firm, then my firm is a micro firm. I'm it. Okay. Alan's comment was taking that CPAs caused Enron's problems. Well, the CPAs, because my son worked for Arthur Andersen at the time, the CPAs hired lit majors out of college, literary majors out of college, to write the footnotes for the financial statements. Because, you know, we accountants cannot write well. Then they had to fill the gap with the time. They put them on audits. They knew nothing about audits, okay? And these lit majors became semi-seniors or seniors, became principals, and it was the CPA who hired the non-CPA that had these people doing the field works. I'm not saying the lit major caused Enron, but it was the CPA who hired the lit major. And then my son, in the organization, because he was a consultant, that organization broke away from Arthur Andersen, if you remember, and formed a consulting firm, and they changed their name to hide themselves, because the major revenue coming out of Enron at the time was consulting. So you had non-CPA pushing the audit at Enron, in my analysis. So there is history.
Well, that would really change, because even under New York state law, you're still allowed to hire and have non-CPAs working on the job as long as it's supervised by a CPA. So that exact example of what happened then, under current New York state law, you could have the exact same rules, and nothing would change.
Now you have a lit major as a father.
So you have a lit major as a principal that can't sign on the statement. So instead you have a partner signing on it, and still have the same rules.
It always is the responsibility of a CPA to put their license behind an audit report. So regardless of the fact that in every firm that does audits that has of size, and that could be Mark's size, Alan's size, Bob's size, they have non-CPAs who work on those engagements, whether it's a junior accountant, under the sort of what I'm hearing, should you never have a junior accountant work on an audit because they're not a CPA? No, of course not, because you'll never be able to train CPAs. So to the extent that the responsibility rests with a CPA who puts their license behind that attest report, none of that will really change. And the CPA who signed the Enron audit statement, if he was uncomfortable having a lit major do all the work on that engagement, he had a responsibility, which doesn't change, to not sign that audit report. So I don't see where the responsibility will shift with non-CPA ownership. And I would make one other comment, which is, think about the definition of ownership and think about the definition of value. And in those instances, it always is the flow of cash, the flow of money that creates value. And non-CPAs can share today in 35% of the profits of the cash flow of a CPA firm. Where we have non-CPA ownership, we don't have CPA equity, which I think hurts the ability to discipline a firm, but we have non-CPA ownership today for many, many years, and it hasn't impacted audit quality in New York State.
Let me ask a question, and then we'll get to the gentleman back there who's been waiting a while. Toward that point, and you folks have all made this, the audit is no longer the same kind of audit. You need a lot of multidisciplinary influence in here. My question is, let me just throw this out. What happens if an engagement or an audit goes terribly wrong, and it stems to someone who is a non-CPA owner? What does that do to the firm's reputation and overall? I mean, the accounting profession 10 years ago had to climb back up after Enron and WorldCom and those Fannie Mae and Freddie Mac and those massive audit accounting failures. What happens there, Alan?
Well, I think it does hurt the reputation. I'm not sure that's an ownership of a CPA firm issue. I think if a person who is not an owner, not a principal, fails on an audit, the firm itself is going to suffer reputationally for that failure. Arthur Andersen did in the most extreme way of basically being forced out of business. So I think it makes it more incumbent upon the CPAs to protect the brand and to ensure that their non-CPA staff, non-CPA owners, whatever the case may be, are adhering to the highest ethical standards that the profession dictates. And I'd certainly speak for my own firm. That's exactly what we do. We do not distinguish in terms of our ethics because somebody's a CPA or a non-CPA. We are a CPA firm. We adhere to the professional standards of the profession, whether it's New York, whether it's New Jersey, whether it's the AICPA, whatever it may be, we adhere to those standards. And I don't think it changes that, but if we fail, it's going to hurt our reputation, whether it's a CPA who does it or it's a non-CPA who does it.
Okay. That gentleman in the back has been waiting a while.
I'm Will Lally from the State Society here, and full disclosure, I do some ethics work here, and I want to help out Mr. Goldfarb too. On the Enron case, technically, it was not an audit failure. It was an obstruction of justice conviction, which was later overturned, and under this scenario, it could have been a CPA or a non-CPA. As the case may be, it was a CPA. But to get back to the point, I'd like to ask the question, what was the original reasoning for having the ban on non-CPA ownership? So why don't we examine that question and see what's changed in the current environment that now has brought 48 jurisdictions to allow non-CPA ownership. And for form of practice, C corporation form was banned, and that was to disallow non-CPA ownership and easy transfer of shares. So what's the original reason for not allowing non-CPA ownership? What's changed? I don't think I can answer that. I don't know. I don't know what the original ban was, but why it was put in place, but I imagine we were CPA firms, and we were a CPA firm doing public auditing or public accounting, and the board probably felt that they needed 100% CPA ownership. That's a guess. I don't know historically. Maybe somebody else does.
I am Dick Peluso. I'm the current president of the New York State Society. I just have a couple of observations, not in favor or not in favor. I'd like to get some thoughts from the panel on two issues related to the UAA. I don't know that all of the 48 states follow the UAA exactly, or whether they've enacted some legislation that might be different from the UAA. But under the UAA, there's two provisions which have created a lot of confusion around the state of New York with the CPAs around the state. One of the issues is, how is the majority determined? Is it going to be based upon the number of partners, or is it going to be based upon the percentage of ownership? There's a lot of passion relative to those two issues, in favor or not in favor of the idea of non-CPA ownership. I don't know the answer to that. I'd like the views of any of the panelists on that. And the reason being that there's a lot of concern that some rainmakers who are not non-CPAs could end up with a higher percentage of ownership of a firm
because it's not based upon the number of partners. The second issue under the UAA talks about that the audit function must be under the auspices of a CPA, and it's sort of delightfully nebulous as to whether or not the auspices of the CPA means that the CEO of the firm must be a CPA, or just the partner in charge of the audit function within that firm must be a CPA. I would just like the views of both of the panel on those two issues, please.
All right, why don't we take the first question first?
I'll attempt it. My view on that is that I believe that the voting rights are what dictate what the majority should be. So whether if it's one person, one vote, then the majority should be in the hands of the CPA. If it's based upon the equity of the firm, then the majority should be in the hands of the CPA. I believe that it dictates, it falls on the level of who has the votes. Well, it could be, but what I'm suggesting to you is that a person who has a percentage, a non-CPA with a percentage greater than 51% should not be able to have a greater percentage than 51%.
I would be concerned as well, because in my firm we have 4 partners. We don't have equal ownership. And if we have, when we vote, there are 4 of us that vote. We have equal shares in terms of voting. We have 1 vote, one partner, 1 vote. If I had 3 partners that were non-CPAs and they owned 49% of the firm equity-wise, I'd be outvoted because we'd have 3 against 1. And that would concern me, because now the control really is in the non-CPA, even though the ownership is 49%. And they may bring in 80% of the revenue, and I bring in 20%. And maybe I'm doing all the administration. I'm the managing partner. Well, I think I'm going to change my name to Chief Operating Officer.
Charles?
I would submit 2 things. I mean, my view would be that it should be a majority per capita and a majority of the voting interests. I think that addresses your question. But to the extent, Bob, that you're a CPA, you have 3 non-CPA partners who have a significant economic interest in your firm, you have a right and an obligation as a CPA. If they do something that you think is inappropriate, that a CPA shouldn't be doing, you would resign from that firm and it would no longer be a CPA firm. So you have absolute control. In that instance, you have absolute control of what the CPA firm does because you're the only one who holds a license.
That's true, in theory. I could quit and I could leave. But
you have an obligation to quit.
Okay, but it's not, in reality, it's not all that easy.
It's your responsibility, whether it's easy or not. As a CPA, we don't do things that are easy. We do things to live up to the public interest and what's expected of us to hold that license. And if our firms can't uphold that license, we cannot be in those firms.
Agreed, but I think it's easier if there are 4 CPAs owning the firm versus 1. I just don't think that you can unilaterally say that, and it may not work in practice. Okay, I might quit, but not everybody would quit.
But you're the only CPA owner, so it's not a CPA firm at that point.
I can't speak definitively, but I do think in South Carolina that is both, is focused on equity and voting rights. Again, to this discussion, I think the ethos of what it is to be a CPA has got to guide this argument as well. I'm like Charlie. I mean, if you find yourself in a situation as a CPA, whether you're an owner or not, you still got the responsibility to be a CPA. You're licensed by the state to be objective, to be independent, to be ethical, and you've got that responsibility on a personal level. And I think that those same ethos need to pertain to a CPA firm, whether they have non-CPA owners or not.
My second issue.
Okay. Dick, if you just want to, because they've been so passionate about this, they probably need a refresher.
The second issue is whether or not the audit function should be, whether a CEO has to be a CPA, or whether just the audit function of the firm has to be under a CPA?
I think the point is very well taken there, because I understand that the CEO of which one? One of the big four is not a CPA. The managing partner of one of the big four is a non-CPA. So there we have a situation where the CEO is not a CPA, and they're running the organization from that point of view with an executive committee, I'm sure. But the point is very well taken. I would certainly think that the managing partner of the firm and the engagement partner have to be CPAs.
In charge of the audit function, the law is very nebulous relative to that point. It just says that I'm paraphrasing, the audit function must be under the auspices of the CPA. Whether that separates from the CEO of the firm or not, I don't know. And I just don't like the opinion.
Doesn't the alternative practice model essentially provide for that as well?
I believe it does.
I think it does as well.
Ma'am?
Yes, Barbara Joseph was speaking again. I don't know in what year the first state that enacted the non-CPA law did so. I don't know what year that was. I know that it takes many years for issues to come to courts to be litigated. If issues have come up over those years, it's possible that they were settled and we never heard about them. For instance, we had 1991, the Foreign Corrupt Practices Act enacted. Very few cases came up. They're now coming to light because the society is going to a global society. When a law is first enacted, we do not have the background to understand how some of these questions, and good questions they are, how they would be resolved. New York State is one of the largest states in the United States. We probably have more CPAs than a lot of the other states. In fact, in this society alone, there are 28,000 members, and I'm sure there are other CPAs in New York State that are not members of this society. I think that we have to take a really good hard look, because our impact is going to be a lot more strong than the impact of some smaller states that have enacted this provision. Thank you.
Agreed.
I think it was 1994 Nebraska.
1994. Yeah. Good point.
Ross Cass again. I'd like to take exception to what Charlie said when he was talking to Bob about the ownership of the CPA firm. If in Bob's example, 80% of the revenue is coming from non-CPA sources, whether Bob is the CPA partner or not, will issue. The focus of the firm is being driven by its revenue sources. And that's not in good needs for the public interest. The public interest should be that a certified public accountant can perform an audit and a test function. That is what the license grants. It's not for consulting work. It's not for tax work. The reality is, yes, you're trying to compete in a market where you've got a lot of large players involved, and the large players do offer services that are not traditionally associated with an accounting firm. And to compete in that market, you need this kind of flexibility. However, from the public point of view, when they hire a CPA firm or read a report from a CPA firm, they expect these people to be CPAs. And that's the bottom line of it. They don't expect them to be consultants selling services.
Or doing tax work, I presume. Accounting firms shouldn't do tax work, is that what you're saying?
I do believe the public expects CPAs to do taxes, and I think 90% of the public think that's all they do.
Okay. Before we go to the audience again, we have some more questions coming in online. And one of our listeners or viewers, I'd like to hear the panel discuss administrative professionals that might be someone a firm would consider for ownership, such as a business development professional or perhaps a firm administrator, now that those positions are becoming more frequent in this profession. Your conversation so far is centered around quote-unquote professional staff as CPA firm owners. What about the others? Charlie, I'll start with you.
We have in our firm as principals I guess you would call them administrative people. So it just so happens that our partner for our HR area is a CPA, but our principal in charge of our IT is not a CPA. However, he is, as a principal, he can participate in profits up to 35% of the firm. Of course, he doesn't participate in a percentage that great. Nobody does. But we have that very situation, and I don't believe that it impacts my personal responsibility as a CPA or the responsibility of the rest of the CPAs in our firm to adhere to the requirements that, or to the regulations that CPAs are responsible to live up to. So we do have that situation. I don't believe that that has impacted negatively in any way our ability to provide high-quality audit and attest services to our clients and to the people who expect us to be performing high-quality audit and attest services.
Let me go Alan first and then Bob.
I just want to ask Charlie a question as a follow-up. I was always told never to ask a question I don't know the answer to, but I'm going to try anyway. Charlie, how does the public interest get enhanced by your IT person becoming an owner? It doesn't change the audit, it doesn't change the essence of what's going on, but now you're making the IT person a partner within the firm, an owner within the firm. You're changing the position, but how does that enhance the public? Okay, it may not hurt the public, but it certainly doesn't help the public, and it's not benefiting the public interest.
And I would say, to the extent that we run an effective and efficient firm and the support that we get from our IT group to help us be better auditors, I would suggest that having a better IT department, and I know it's not sort of a one-to-one kind of correlation here, but I would suggest that the more efficient and the better our firm runs and our ability to use technology to audit effectively and efficiently benefits the public greatly. So to the extent, the public interest greatly, and to the extent that we can attract a highly qualified IT director who can participate in our profits, which enhances our mission, which is to provide high-quality audits to the public, I would say it does ultimately and directly enhance the public interest.
What I know of you and your firm, I'm sure that you couldn't be better run or more efficient. Yeah. So I think you are at that point now, and I think making him an owner doesn't change, him or her an owner doesn't change your firm. Yep. And it certainly doesn't change the equity, because you're going to give him the same ownership, the same profit percentage, whether he's an owner or not an owner.
Right. And Bob, thank you for your comments. And that's why I do think this debate is about semantics. So if he can share in the profits, he's an owner. But that's what an owner is. An owner shares in the profits.
All right, let me, I was going to say, everybody's been kind of ganging up on Bob, but to his point, let's be, I have a question here. We're talking about non-CPA ownership. Now, there's a lot of positions now that maybe weren't common in the profession when a lot of you folks started, such as a business development manager or a marketing manager or even a firm administrator. Now, for example, if you have a business development manager who's also one of the owners, do you think that making him an owner or her an owner, does that present an inherent conflict of interest since their mission is to just drive revenue? Does that undermine the firm's commitment to the establishing client trust and their service to the public? Alan, go ahead.
I don't think it does. It can. It has the potential with it, but so too can that conflict exist when you incentivize partners to be rainmakers and business developers. I think it's the same. It's essentially the same issue, perhaps the same coin, different sides. We have a marketing professional who is a principal in our firm. To the public's interest, if we are a growing, strong, thriving firm, we have the ability to attract and retain talent. And to the extent that she sits at the table and helps us with our strategic direction and feels and acts like an owner and has ownership, it aligns all of our interests in the right way. At the end of the day, once again, it boils down to doing the right thing based upon what we as professionals are sworn to do when we become licensed professionals. And so I don't believe that a marketing person who is incentivized to bring a business is going to have is going to do things the wrong way, because as a firm, we have client acceptance procedures, and we have policies that center around that, because as part of our professional responsibility, we can't accept and bring in every client just to raise the revenues. It's all about bringing in the right clients in the right set of circumstances and doing the right thing for the public interest.
Mm-hmm. He's remembered his next comments, right?
Right. Right. Well, this dovetails to Dick's question about how you determine percentage, and it's what I was whetting everyone's appetite about. It doesn't affect New York because we, at the current time, do not allow non-CPAs to have an ownership interest, but it affects the 47 or 48, I've heard several numbers this morning, states that do have non-CPA ownership, and I haven't seen it raised by anybody other than myself. I'm a tax professional, but my new subspecialty has been a PTIN, the Prepare a Tax Identification Number. And I've written 3 articles, or I've had 3 articles published on this. And within the last year, after the service initially started the PTIN drive, in the last year they came out with a ruling with a term called supervised preparer. And a supervised preparer is somebody that works for, in our case, a CPA firm, not a CPA, prepares tax returns, has to get a PTIN, and would have, except for this rule, had to take the test that the Internal Revenue Service is now giving to non-CPAs. And a supervised preparer is defined as somebody that works for a CPA, and in a CPA firm that's 80% owned by CPAs. And the same thing applies to law firms, et cetera. So in one of the articles that I wrote, I raised the question as to how is the 80% determined? And I said, is it determined based on percentage ownership? Is it based on sharing of profits? To me, those were the 2 ways that you should look at it. Well, there's a program called Tax Talk Today, which is sponsored by the Internal Revenue Service. And they had a session on January 10th. I registered for it sometime in December, and I sent in 5 questions. And one of the questions that I raised, and the reason I registered for it was because one of the people speaking was from the PTIN section of the Internal Revenue Service. So the question I raised was, to be a supervised preparer, the individual taxpayer must be employed by a firm that is at least 80% owned by CPAs, attorneys, or enrolled agents. The 80% question is specifically asked on the new edition of the IRS Form W-12 and online filing for a PTIN or PTIN renewal. How is the 80% calculated? And in my way of thinking, it was based on the 2 percentages I mentioned before, and I was really surprised by the answer. The fellow from the IRS said, well, it's pretty simple math. There's nothing complex here, and we're not trying to hide anything from the light of day. It's basically, you have to look at who are the owners of the firm, who are the partners. And let's say we have a firm of 10 individuals. If 8 of them are CPAs or enrolled agents, they meet the 80% threshold. And therefore, that firm qualifies to have supervised employees. Once you have non-CPA ownership, you could have a firm that's 85% owned by a CPA and 1% owners of IT people, forensic people, et cetera. And under this IRS, if this fellow is right, under this IRS rule, you're going to have all your non-CPAs doing tax returns take the test. And you're going to have to disclose to them what the ownership is, et cetera. So this is not a question, it's just a comment, and as I said, it segues into the percentage ownership issue that Dick raised, and I think it needs to somehow be brought to the attention of the Internal Revenue Service by the 40-some-odd states that currently are practicing with non-CPAs as owners.
I was going to say, you must be a busy man with the PTIN. I think the only people who aren't upset about that are the CPE providers and the test examiners. This is going to be about 12 to 15 million extra hours of CPE because of this PTIN and the tax preparers. Let me take another question here online. And one of the viewers asks, attorneys have privilege before the courts. Have we considered the impact of non-CPA attorney owner of an accounting firm and, again, our public trust responsibility? Anybody like to take that one? Charles?
We have a number of attorneys who are not CPAs who work in our firm.
Their specializations are as far-ranging as employee benefits through to international tax. And they can't practice law in an accounting firm. And they do not practice law while they're working for our firm. So I'm not, they may have a personal conflict with respect to maybe some of their obligations as a lawyer, but they cannot practice law inside an accounting firm. So to the extent that they would be a non-CPA owner of our firm, they would not be practicing any law as part, well, they don't practice any law inside or outside of our firm, but they certainly would not be practicing law inside our firm.
Okay, kind of another devil's advocate question, probably weighing on the side of Bob. And how does a firm with non-CPA owners, quote unquote, control a situation where, say, they own 49% of the firm, the maximum allowable by most law, from having 90% of control of the firm? How do you kind of regulate that? Anybody? Alan, you want to take that one?
Yeah, I mean, I think it's what Charlie said before, that at the end of the day, if the non-CPAs control the firm in that regard and the CPAs aren't on board with those decisions, they have an obligation, they have an ethical obligation to remove themselves from that situation, which means the dissolution of the firm, which essentially means that you're not a CPA firm anymore. And I think, while I understand the practical side of that and the pressures that are brought to bear in those situations, that's what we get called upon to do. And I think that's what we as professionals have to do at the end of the day.
Sure.
No, I was just going to say that, again, I think that the ethos, what the ethical meaning of what it is to be a CPA needs to drive the firm as well, and that's the bar that needs to be measured by.
Ralph?
Yeah. I just so happen to travel with our statutes here from New Jersey.
Only that?
You never know when you get a call from somebody. Their expectation in this environment is that you can provide an answer. But our rules regarding firm ownership require that not only the CPAs possess the majority voting rights, but also the equity. So if you're talking about how you get your arms around there are ways to do that so that the control truly remains in the possession of licensed CPAs.
Okay. Sir.
Hi, my name's Frank Gallo, and I kind of agree with Alan that the CPA's responsibility would be to resign from the firm if he didn't like what his non-CPA partners are doing. But believe me, these non-CPA partners are going to scramble to promote somebody within the firm to be the CPA partner, or hire somebody from the outside to be the CPA partner, or do some sort of joint venture to keep their practice alive. So in reality, these non-CPA partners are not going to give up a revenue stream if they need to put somebody in place. So we'll have that 21-year-old junior who's a CPA is going to be the partner in that firm, and they're going to keep him on the string because they want to keep their revenue stream. This is going to be a killer. I mean, yes, the partner who's got responsibilities, who's got ethics is going to resign, but they'll find somebody in this profession to take his place, and I think that's the big fear I have.
That's a problem. Using New Jersey statutes, there would have to be a majority owner, and there would have to be majority voting. So all of a sudden, these people that are making so much money are giving this kid a majority ownership of the firm. I think from a business standpoint, that's just not realistic. But it goes to what Charles said before. Some of this is just semantics. If we're so concerned about it, why have we allowed it to happen all these years? We have it in place now. So the concerns and the fears that you're addressing are the same firms in, when American Express took over GGK or any other firm, it was no difference.
Bob?
Perhaps there's some constraint in New Jersey to prevent an 80% owner, a non-CPA owner, but I agree that the CPA should resign in that situation, of course. But why should I even be put into that situation? If it's 100% ownership, CPA ownership, I would never be put in the position of non-CPAs putting me in a minority position. I'd never have to be there, and I wouldn't have to resign because the non-CPAs are controlling the company. whether they have equity or not, they may have revenue that's brought in that is 80, 90, 95% versus mine, and there would be pressure for me to quit. I wouldn't have that pressure if I had all CPAs own, or maybe there is an ethical problem within the firm that I would want to quit because of, but not because non-CPAs are putting pressure on me. So why be put in that position? It doesn't enhance my firm.
But if they control 80% of the revenues, they're going to put pressure on you
They are
because
going
they're
to
going to threaten you to leave.
I understand,
and you're in
but
the same spot.
I agree, but if there are 80, if my 3 other partners have 80% of the firm and they put pressure on me, fine, I'm going to still leave. But it's not because it's the non-CPA that's putting the pressure on me. It's because I don't like what's going on in the firm.
No, I'm suggesting that if the non-CPA owners control 80% of the business, whether they're owners or not, they control it de facto because they sourced it, they maintain the relationship, and so on and so forth, that pressure still exists. The pressures exist in the world regardless of what the rules say.
Agreed.
It's how we respond to them as professionals.
Charles?
Mark, I would defer to you. I know you're chomping at the bit, and I think, I know you're ready to answer this.
I was just going to say, the best thing about this dialogue is that we don't have to invent it all. Since 1994, there have been 49 states in the aggregate that have gone down this path. I don't recall, and I'm certainly not an expert, I don't recall reading about many of these issues. Maybe there have been issues and it's just escaped me, but I think we have a history that we could build upon, and it would be a shame because our profession keeps meeting challenges, and I think you have to keep on going forward. And to stagnate and not embrace the opportunity to make us better, to level the playing field, to make us in New York as competitive as our colleagues in other states, it would be an oversight. But I would encourage dialogue like this to continue. But look to 1994.
Gentleman in the back.
Hi, I'm Paolo Espiritu. I'm a partner of Padilla & Company. I have a comment regarding the topic that was raised earlier on the work of a non-CPA partner as to how it affects the audit work as compared to just being hired as an expertise by a CPA. I think it does have an effect because if a non-CPA, for example, an IT professional gets involved and he is a partner of the firm and he is involved in an audit work, by being a partner, it elevates his legal responsibility on his work by having equity on the firm. And he would be more concerned on the work he does as an IT professional as it relates to the audit work as compared by just being somebody who is a consultant and just hired by the CPA, wherein the ultimate responsibility lies within the CPA. It's true that the CPA would be the one who will sign, but by having an equity on the firm, it increases his legal responsibility as a person, as an owner of the firm on that work being performed. So, yeah.
Anybody? Okay. I guess we're in agreement. For the first time, all morning. Take a picture of this. Well, we already have a picture of it. Anybody else?
I'm Viola, also from Padilla & Company, and I have a question. It looks like, and it seems like the major issue is the problem why a non-CPA cannot own an equity is that because of discipline. My question is that, is it possible then that even though the committee or the society will pass a bill that if a non-CPA owns an equity, that he will be subject to the same disciplinary action as that of a CPA? Would that address the issue?
I don't see how the State Board of Accountancy would have that jurisdiction. The State Board of Accountancy would not have jurisdiction over a non-CPA.
Yes, right. If they pass a bill that they...
Yeah, I understand that you could pass, the legislators could pass a bill, but I don't think they would ever do that. And I don't think that you can give the authority to the State Board of Accountancy over non-licensees.
No, I mean,
Their whole function is to regulate licensees. That's all they can do.
No,
So,
but
so if a non-CPA signs an audit opinion, not legally, but if they do it, and I have seen it at least once in my lifetime, a lot more than that, the State Board of Accountancy can't go after that person. They can just say stop and desist, but there's no disciplinary action. They just have no reach, and that's a concern. I don't think you can even give them the reach.
To some extent, they have reach. Anyone who's not a CPA is not entitled to sign an attest report. So to the extent that that individual who's not a CPA is trying to sign an attest report, that's a matter of law. That's not a matter of discipline, I would think. So there is some reach. And to the extent that
I believe it's an AG issue. An Attorney General would
Yeah,
go after
well,
that person,
so-
but not the State Board of Accountancy.
Okay, well, as long as I would, if I had to pick the poison between the Attorney General or the State Board of Accountancy, I would always pick the State Board of Accountancy.
I think they
If I had
have
to
more
pick my
potency
poison.
than the AG. I might be biased there, Joe.
But, well, just stepping back a second, I mean, I guess I would, although I'm very much in favor of non-CPA ownership, I do think that there have to be adequate safeguards. And Ralph, you talked about the safeguards in New Jersey. South Carolina has its own safeguards. I wouldn't suggest that there shouldn't be safeguards. I'm just suggesting that in the modern world that we live in, it is an improvement to audit quality to have the best talent performing audits. And it's so multidisciplinary now that I just think it would be a public disservice to continue with the model that we have in New York, although I do honestly believe that what we have in New York now, it's just semantics anyway, because, as you said, American Express and RSM, before they unwound their alternative practice structure, and other consolidators, they already provide for much more than majority non-CPA ownership.
There's a Bob in the back.
Thanks. My name is Robert Fliegel. I have just a couple of observations to make. It was a really very nice, interesting discussion. Relating to what the gentleman over here said a few minutes ago, I think it's an important distinction, which is the partner title does mean an awful lot, and it does come with a lot of legal restrictions depending on the partnership. There's quite a number of people I've worked with over the past 20 years that are non-CPAs, very talented people in various consulting aspects that want to be a partner. They want to sit at the table. They want to be bound by the partnership obligations. And so I think that's an important distinction, that aside from the CPA attest function and being able to sign, that people really do want that obligation. The second thing is that, at least from my knowledge, most of the major failures in the profession have come from the very, very large firms. So it's not like an epidemic of problems from attest, non-attest, CPAs, non-CPAs. And it could be in those large firms, from some of the cases I've read, even going way back, that there was some undue influence from clients that were just too big, whether it was consulting fees or whether it was audit fees, that the partners made gigantic errors in judgment because they were influenced by the fee revenue. So that's just an issue that comes up in business, I think, more from size of company and dependence on clients and other things. And the last thing I'll mention or just state is that since so many other states do this, and I'm suggesting New York probably should as well, that maybe there'd be some novel way of doing it. Maybe New York should take a unique position of some sort in going in favor of it, but perhaps with some other restrictions or some other different ideas that other states haven't done, just to be different. My comment.
Dick, and then Mr. Ingram.
While I'm not necessarily here to defend the large firms, I would say that that's not necessarily true. It happens, when it happens with a large firm, you get the headlines that you don't necessarily see with the smaller firms. but I would remind everybody here that the Madoff thing was the fault of an individual practitioner, and not just an individual practitioner, but unfortunately, he was a chapter vice president in the New York State Society. So that's not necessarily a large firm issue. Failures happen all over the place, and it's either because people are dumb, stupid, or just dishonest.
Not necessarily in that order.
Donald Ingram again, from Micro Firm.
Micro firm.
Charles, I want to make a statement. I don't want to be pejorative, but I have personally observed and personally reported a person on the web advertising as a CPA, okay, doing CPA. I reported it to the AG. I reported it to the accounting board. The AGA or somebody pulled the website. I got a letter from the accounting board saying, we told that person, don't you ever do that again. And that's all they did.
We have been talking about this issue really from the perspective of a CPA firm hiring or becoming partners with a professional within the firm to promote what the firm does. Let's just talk about the situation in reverse. Let's talk about the American Express who decides that they want to buy a 49% interest, or the life insurance firm or the annuity sales firm that wants to get at the clientele of the accounting practice, so they buy a 49% interest, even on an individual level as opposed to a corporate level. By adopting this kind of legislation, we're opening the doors for that kind of situation to one day happen. It might not be the first step of the legislation, but surely will start the direction going.
But the legislation does say that all non-CPA owners must be actively engaged in working for the firm.
So I don't think we have, although American Express was a passive owner, and I mean, I think my feelings are clear on that, but under the provisions of the UAA, I think you wouldn't have a situation like that.
Yeah. Well, let me take that one step further, because over the last couple of years, you've seen instances of venture capital coming into accounting firms. There was one down in Philadelphia. I think there was a couple out in California. What about the VC folks? I mean, they're not going to be actively involved in the firm.
Well, they set up an alternative practice structure. So it looks just like the alternative practice structures for American Express that they had in place, an alternative practice structure for RSM before they bought their firm back from the public company. But it is interesting. I just came back from a trip to England, and in the UK, there are accounting firms that are public companies. Now, they separate out their attest function from the rest of the firm in their own alternative practice structure, but there's a firm called Tenon, RSM Tenon, that's a public company in the UK. I visited with a firm that had 28% ownership, exactly to your point, 28% ownership by a mutual fund, a Canadian mutual fund group, bought a 28% interest in an accounting firm in the UK. So however the rules and laws are structured around the world, we are seeing that creep of institutional ownership into CPA firms.
How do you feel about that?
I like safeguards. I'm not comfortable with institutional ownership, and I don't feel that it's a level playing field. When I competed against partners at RSM before they now own their firm back, I personally have a substantial amount of capital in my firm. I have all the working capital comes out of the money that I leave in the firm. I guarantee our leases personally, our bank lines. That partner that I was competing against for RSM didn't have any capital in his practice, didn't have the same financial risk personally that I had in the CPA firm that I work for. So I did not feel as though it was a level playing field. If I had to buy technology
for EisnerAmper or authorize the purchase of technology for EisnerAmper, I'm personally writing a check in that. So I have to believe in every aspect of maintaining my CPA license, because if I lose my CPA license, the firm is out of business. The RSM partner did not have 10 cents, not even 10 cents of equity or financial stake in his CPA firm.
Let me go back to a firm level. Let me ask Chuck this question. You know, the double R's, recruiting and retention. Has ownership helped, hurt, remain level as far as recruiting and holding people in your firm?
Well, again, South Carolina has the provision for non-CPA ownership. However, I'm also in a small firm. We have about 40 people, top to bottom. We're 100% owned by CPAs. Now, on a personal, professional, and regulatory level, I think you need to ask the question, will the public be hurt by these provisions? And I don't come to that conclusion either from a practical standpoint or from a theoretical standpoint. I think you have the same issues with 100% owned CPAs. You have bad apples. That's what you discipline. I do think, and Charlie's alluding to this again, I think that the safeguards, the ethics that this is what it means to be a CPA firm still needs to be part and parcel of any kind of model that you adopt. I do think there's experience from all the other states. I think you're living, and this is, Bob, I think you're living with the reality and form right now. It's just a matter of go ahead and regulate it. I think you've got the situation.
Okay.
Alan Weiner, a little more history.
Please.
And Charles is an LLC, and Bob is an LLP.
It's wrong. We're an LLP.
Oh, okay. Well, you could have been an LLC. Well, you could have been a PLLC or a PS LLC.
Or a PTIN.
Okay, my point. So PCs came into New York law in 1970, and I'm sure that the same arguments were brought up before New York enacted the professional corporation, because before that, everybody that was an owner of a professional entity was wholly liable. And LLPs and PLLCs we got in 1994, and that too protected many of the owners, not the owner committing the malpractice. And so it becomes the same argument, the same issue that may have existed back then as to, well, is the public hurt? Well, sure the public was hurt, because the liability of many owners is greater than the liability of one owner or the assets. And I'm sort of hearing the same thing. I think that non-CPA ownership, we live in 2012, and I think non-CPA ownership has come. And I think that the state should seriously look at it and enact some form of statute. And I use history as a basis for possibly pursuing that.
Mark?
I think the dialogue this morning has covered a lot of the perspective of why or why not for the CPA. And a few times we started, and Ross just asked a question, so I'll bring it back to the panel. I think we serve the public's best interest. That's always what's driven reform in our profession, is are we serving the public's best interest? So just by way of example, in our dialogue this morning, I think it came up earlier, Charlie, you might have mentioned it, the expertise that's needed to provide a proper audit today has changed from when we all started. Major accounting firms, if they're performing in the financial services industries, they need people with financial engineering backgrounds. And if it serves the public's best interest to have owners in a firm as opposed to employees in a firm, then I think we have to take a look at what's the difference between an employee who's a non-CPA and an owner who's a non-CPA. And I think you'll probably come to the same conclusion of what makes a CPA in a firm better when he's an owner than when he's an employee. It's that ownership mentality. And I think from the public point of view, I'd be curious how you feel about why we're not addressing this from their perspective.
I don't see where the public interest is enhanced by having non-CPA owners. It may, whether they're an owner or not an owner, you're going to still need to employ them to do the best possible audit. Making them a partner doesn't make them better, doesn't, hopefully not makes them worse, but it doesn't enhance the audit, doesn't enhance the firm. And maybe the public interest is not harmed, but as you say, Mark, the primary purpose is what is in the best interest of the public, not what doesn't hurt the public. So we always have to look at what is in the best interest of the public, and I don't think making non-CPAs owners in a CPA firm is in the best interest of the public. What also potentially concerns me is I don't want to use the term inflation, but legislation I would hope would say in New York, if it ever came down, that there would be a need for supermajority. That's what I would hope if this ever happened. But if it becomes 49%, what happens in 5 years or 10 years from now, or hopefully 100 years from now, when the 49% becomes 62% or 51% or 84%? Just because there's a 49% number at initiation doesn't mean it will stay there. And maybe somewhere down the road we'll be saying, okay, let's increase the 49 to 64% or some other number. Even Chuck said in his opening remarks that they were toying with the idea of going from a supermajority to a simple majority. Already you're talking about reducing the percentage of CPA ownership. That would bother me as well, and there would have to be some regulation on that and some restriction, but it doesn't mean that it won't happen down the road. I think not instituting it now is the only way to go.
Okay. Well, I see we're getting close to the bottom of the hour, so I'd like each of our panelists, Bob is already gone, to give like 1 or 2 minutes restating their position, and then we'll close it up for the day. Alan?
Thank you. Again, and thank you so much for the opportunity to be here today. It has been an interesting debate. Again, we talk about the public interest, and I think the public interest is served at the end of the day by having non-CPAs have an ownership stake in the firm. Number one, as many people have indicated, they now have a financial stake. It's not just a rules-based stake, but they have actually skin in the game if they are an equity owner within the organization. And so therefore, every day they come in, they're leaving their capital behind. Number two, as a firm, we have greater ability to discipline and to hold partners accountable than we do employees. We can fire employees, but they can compete. And with partners, we can hold them to a higher standard of a non-compete clause than we have otherwise. And probably more than anything, at the end of the day, it's portfolio without distinction. We've heard it many times, semantics. Many firms are operating today with CPA ownership, although they are jumping through hoops with which to do that. And so at the end of the day, they are really accomplishing the same goals. And by precluding them from going the full circle, by precluding them, holding them out, we're creating second-class citizens, and it does present a problem in terms of our organizations and keeping people focused on their goals and objectives of the firm. So I think that we're there already. I think it's time for New York to step up like the other states, particularly neighboring states, and to follow suit.
Chuck?
Well, I do think it's important that you ask the question, will the public's interest be hurt? All things equal, I would say if you can't answer that, is there going to be some detriment to change to a new form that in reality already exists? I would say you would adopt rules to regulate it in form as well as in substance. With regard to the 2/3, I must admit, again, as we've gone around, as we've opened up our Practice Act from time to time since '98, there have been other issues that we've had initiatives to drive through as a change. There's not been that appetite to necessarily change the two-thirds majority, but our focus was perhaps on another legislative matter, and so not clouding the water at the time. We focused on those other matters. I do appreciate the opportunity to visit with you. I know it's obviously an issue that creates some discussion, and I wish you the very best as you go forward with it. Thank you.
Charlie?
I would just like to say that, Bob, I think you stated the position well and fairly and responsibly, and there is a debate and there is a question. And Alan and Chuck, I think you pointed out some of the reasons on the other side why this may be good for the profession. But our profession, as we've heard from our historian Alan Weiner, our profession has changed. The CPA profession has changed over time. And 70 years ago and prior to that, perhaps we weren't known for being tax preparers. But as the world changes and as the world we practice in changes, one thing doesn't change, and that's the basic tenet of what it means to be a CPA and your personal obligation and responsibility to hold that designation. So whatever the form of ownership, whatever the practice areas that we're in, if you hold that CPA designation, you need to hold yourself to a higher standard. And regardless of what we do with this legislation, I do think that will not change.
Well, I don't think our distinguished panel held anything back today. It inspired some passionate discussion, and we'll see what happens. But please, give them the big hand.